Imagine you're finally starting to take retirement seriously. You want to save more, invest your money, and build a future where you don't have to worry about every paycheck. Then you open your retirement account options and suddenly see two names everywhere: 401 and Roth IRA. And this is where things get confusing. Which one should you use first? Is a 401 actually better because your employer may contribute money? Or is a Roth IRA more powerful because your future withdrawals can be tax-free? The truth is, there isn't one account that is automatically better for everyone. And choosing the wrong strategy or simply using these accounts in the wrong order could cost you thousands of dollars over the years. So in this video, we're going to break down 401s and Roth IRAs in simple terms, compare their biggest advantages and disadvantages, and by the end, you'll understand exactly how these two accounts can work together to build your retirement. Let's start with the 401. A 401 is a retirement account commonly offered through an employer. You decide how much of your paycheck you want to contribute, and that money is generally invested into options available inside your plan, such as stock funds, bond funds, or target date funds. One of the biggest advantages of a traditional 401 is the tax treatment. When you contribute money to a traditional 401, your contribution can generally reduce your taxable income for the year. In simple terms, you're putting money into retirement before paying income tax on it. For example, imagine you earn $70,000 a year and contribute $7,000 to a traditional 401. Your taxable income may be reduced by that contribution, depending on your circumstances. But there's a trade-off. You don't get to avoid taxes forever. When you eventually take money out of a traditional 401 in retirement, those withdrawals are generally taxed as ordinary income. So the basic idea is simple. You potentially get a tax benefit today, allow your investments to grow inside the account, and pay income taxes when you withdraw the money later. But there's another feature that can make a 401 extremely attractive. Your employer may offer a match. Imagine your employer says, for every dollar you contribute up to a certain percentage of your salary, we'll contribute money too. That is essentially additional compensation for participating in the retirement plan. For example, if you contribute enough to receive the full employer match, you may be leaving valuable retirement money on the table if you don't participate. And this is one of the biggest reasons you should understand your workplace retirement plan before immediately choosing another account. Now let's move to the Roth IRA. A Roth IRA works very differently from a traditional 401. With a Roth IRA, you contribute money that has already been taxed. You don't generally get a tax deduction for the contribution. But here's where the Roth IRA becomes interesting. If you follow the applicable rules, qualified withdrawals in retirement can be completely tax-free. That means the money you contribute today can potentially grow for decades, and qualified withdrawals of contributions and investment earnings can come out without federal income tax. Think about what that could mean. Suppose someone invests money in a Roth IRA in their 20s or 30s and leaves it invested for decades. The original contribution is only one part of the story. The real power comes from the potential growth over time. And if the future withdrawal is qualified, that growth can potentially be accessed tax-free. This creates an important difference between the two accounts. A traditional 401 is often about getting a tax advantage today. A Roth IRA is often about getting a tax advantage later. So which one is better? This is where people often make the mistake of treating the decision like a competition. 401 versus Roth IRA. Winner takes everything. But that's usually the wrong way to think about it. For many people, the better strategy may actually be using both. Let's say your employer offers a 401 match. A common strategy is to contribute enough to your 401 to receive the full employer match, assuming the plan and your financial situation make that appropriate. Why? Because otherwise, you could be giving up part of the employer contribution available to you. After that, depending on your income, eligibility, tax situation, and goals, you might consider directing additional retirement savings toward a Roth IRA. This gives you something very valuable: tax diversification. Instead of having all your retirement money treated the same way for tax purposes, you can potentially have money in different types of accounts. Imagine retirement arrives. You have money in a traditional 401 where withdrawals are generally taxable. You also have qualified Roth IRA money, which can potentially be withdrawn tax-free. That flexibility can become very useful when managing your income and taxes in retirement. But there's another major difference you need to understand. A 401 is controlled by the employer's plan. That means your investment choices, fees, and available funds depend heavily on the specific plan. One company might offer a very strong, low-cost selection of investments. Another company might offer fewer choices or higher fees. A Roth IRA, on the other hand, is an individual retirement account. You generally have much more control over the account and can choose from a broad range of investments available through the financial institution you use. This flexibility is one reason some investors love Roth IRAs. But Roth IRAs also have limitations. Not everyone can contribute directly to a Roth IRA in every situation. Eligibility and contribution rules can depend on income and other factors, and those limits can change over time. So before making a decision, you should always check the current IRS rules or speak with a qualified tax professional. Now let's talk about something people often overlook: access to your money. A Roth IRA has special rules that make contributions different from investment earnings. In general, Roth IRA contributions can be withdrawn tax and penalty-free because those contributions were made with money that had already been taxed. But that does not mean you should treat a Roth IRA like a regular savings account. The investment earnings have additional rules, and withdrawing money early can create taxes or penalties, depending on the circumstances. A 401 also has restrictions around withdrawals, although there are exceptions and different rules depending on your age, employment situation, and the type of 401. The important lesson is this: retirement accounts are designed for long-term investing. They should generally not be viewed as your emergency fund. You want your emergency savings and short-term financial needs handled separately so you're not forced to sell long-term investments at the wrong time. Now let's imagine two people. Person A earns a good salary and has a 401 through work with an employer match. Person B is self-employed and doesn't have access to an employer-sponsored 401. Their best strategy may look completely different. Person A might prioritize the employer match and then consider other retirement accounts. Person B might have more flexibility through an IRA or other retirement options available to them. This is why copying someone else's retirement strategy can be dangerous. Your income is different. Your tax bracket is different. Your employer benefits are different. Your age is different, and your retirement goals may be completely different. Instead of asking, which account is universally better? Ask a better question: what combination of accounts gives me the best strategy for my situation? That mindset can completely change how you think about retirement. Now let's make the comparison extremely simple. A traditional 401 can give you a tax advantage today, potentially includes an employer match, and allows substantial retirement savings through an employer plan. A Roth IRA uses after-tax money, but qualified withdrawals can potentially be tax-free, and you generally have more investment flexibility. The 401 can be powerful because of the employer match and higher contribution potential. The Roth IRA can be powerful because of tax-free qualified withdrawals and investment flexibility, and together they can create a very strong retirement strategy. But remember one important thing: the best retirement account is not necessarily the account with the biggest tax benefit on paper. The best account is the one you actually use consistently. Someone who spends years researching whether a 401 or Roth IRA is better but never invests is not building a retirement plan. Meanwhile, someone who starts investing consistently, increases contributions over time, keeps costs under control, and stays invested through market ups and downs may be building something much more powerful. Because retirement wealth usually isn't created by one perfect investment. It is created by thousands of small decisions repeated over many years. You don't need to become a financial expert overnight. You need to understand the basics, choose a strategy that fits your situation, and stay consistent. And if you're still confused about which one you should choose, here's the simplest framework to remember. First, understand your employer's 401 and whether it offers a match. Second, learn how much you can realistically save. Third, understand whether a traditional or Roth approach makes more sense for your current tax situation. Fourth, consider using both types of accounts when appropriate. And finally, review your strategy as your income, career, family, and retirement goals change. Because the retirement strategy that makes sense at 25 may not be the same strategy that makes sense at 45. Your financial life changes. Your retirement plan should be allowed to change with it. So, is a 401 better than a Roth IRA? Not necessarily. A 401 can be incredibly valuable, especially when an employer match is involved. A Roth IRA can be incredibly valuable because of its potential for tax-free qualified withdrawals and greater investment flexibility. But for many people, the real answer isn't choosing one and ignoring the other. It's learning how to use the right account at the right time. And the earlier you understand that, the more time your money has to potentially grow. If this video helped you finally understand the difference between a 401 and a Roth IRA, hit the like button, because it helps this channel reach more people who are trying to get better with money. And if you want more simple, practical finance videos that explain complicated money topics without making them confusing, subscribe to the channel. Because your future financial situation can be changed by the decisions you make today. And sometimes, the most important financial decision isn't about making more money. It's about knowing what to do with the money you already have. Thanks for watching, and I'll see you in the next video.